So it's another bank that has benefited from the economic recovery that has been seen since COVID-19 plunged South Africa's already struggling economy into the doldrums. Standard Bank posting record headline earnings of 15.3 billion rand in the first half of its financial year. Now, the record earnings allowed the bank to increase its dividend by 43%. So we've got the Chief Executive, Tshabalala, who joins me now to talk about these numbers. No doubt you have ushered shareholders into the weekend on a very happy note, Sim. In your results, you speak about some strategic undertakings that the bank embarked on to ensure this kind of performance. Talk us through some of those undertakings that really produced a solid set of results.
So first of all, thank you so much for the opportunity to chat to you and your audience. I think you're right. The Standard Bank numbers bespeak incredible franchise momentum, which is what's driving top-line growth. You had a great performance in net interest income, a great performance in non-funded revenues. That is because we had a larger number of clients. We had a larger number of clients transacting on our payment systems, our ATMs, our branch network. You had a larger number of products that were being sold to a larger base of clients. You had South African consumers borrowing more. And as a result of them borrowing more, particularly in home loans and vehicle and asset finance, that gives rise to a higher base off which to charge interest, and therefore net interest income was higher. Interest rates continued to increase, which resulted in higher net interest income as well. I think the South African consumer was in good shape, notwithstanding the challenges post-COVID. In addition to all of that, we saw improved activity in our Africa regions business. Again, a similar story. More people borrowing, more people paying us our interest, more people transacting through our IT systems, our ATMs, and our branch network. And so all in all, the summation of a number of strategic decisions made to grow the number of our clients, increase the product set, and actually increase the resiliency of our IT systems.
I mean, you speak about customers coming to you to get vehicle asset finance and home loans. I mean, does that speak to the health of the consumer? Does it correlate with what you saw in terms of credit impairments in the period?
So first of all, we saw investment income improving for the high end of the market as a result, I suppose, of people generating dividends and interest from their investments. We've seen from the statistics that many of the upper end of the market were able to retain their jobs. We saw household debt to income ratios remaining relatively high, and we also saw household debt servicing costs being relatively low. As a result of that, people have got capacity to take on more debt as they purchase homes, purchase vehicles, and as they transact. It is true, however, that we've seen an increased set of interest rates by more than 1% this year, and we're expecting 0.75% increase in interest rates in the second half of this year. The result of that is that you're seeing strain in our consumers, and we would expect that to bleed into our numbers in the second half and into next year. However, the deterioration in our credit loss ratio, which is what you're referring to, was not as a result of consumers or small businesses, but was as a result of the normalization of bad debts in the corporate book. So a number of corporate clients were in difficulties, which gave rise to the need for us to provide.
Let's talk about the outlook for Standard Bank. I mean, you guys indicate that you are looking at a strong second half and overall low double-digit growth for the full year. What informs the kind of outlook that you're seeing, given the fact that you do acknowledge that the operating environment is still quite a tough one, Sim?
You're absolutely right. You know, globally, we think that inflation is going to continue, and as a result of that, you're going to end up with tighter financing conditions, higher interest rates. And global GDP is likely to be around 3.2%, Sub-Sahara around 3.8%, and South Africa around 2.3%. So a tough environment. We think that, as I said, interest rates in South Africa will increase by 0.75%. as a result of increasing inflation. But we are starting to see signs. You've seen it in a slowdown in the increase of the price of oil. Soybean prices, wheat prices starting to pull back, which suggests that by next year, the levels of inflation will have moderated. The result of that is that an interest rate cutting cycle may happen sooner than people would expect. Off the back of that, we're going to continue to execute our strategy, continue to increase the number of our clients, continue to roll out new products for them, continue to digitize them, continue to grow our partnerships, and continue to participate in other people's ecosystems. In other words, people whose businesses are adjacent to those of ours, and get the benefit of the scale and size of this institution.
One big headache in the country, Sim, at the moment is electricity and the lack thereof. Does Standard Bank have anything in place, offerings to consumers that other banks have initiated in terms of financing for solar projects that they might like to embark on and really just rid themselves on the reliance of Eskom?
Absolutely. We are a big participant in the infrastructure and power sector in South Africa. We actually have a disproportionate market share. We enjoy a large market share, both for corporates and for governments and for individuals as well. We've participated in the independent power producer programs. We are there in each of the bid windows, including bid window 6. And in fact, as I say, we've got a high proportion of that market share. We also service municipalities who are contracting with independent power producers to get the benefit of distributed power generation. And we are talking both to the suppliers and to these municipalities. We've got good relationships with sponsors of these major projects, and we continue to participate, as I say, then in that part of the world. As far as individuals are concerned, we have got a set of products and services that provide people with loans and financing mechanisms for the purposes of purchasing solar water geysers. And so we're participating, therefore, in the improvement of the renewable sector in South Africa, both for corporates and for consumers.
I know you're a man in demand today, Sim, so this is my final question to you, a broader one, the greylisting issue, the cloud that hangs over our financial services sector. Your thoughts on the immediate action that needs to be taken so that we don't see the worst next year, as has been warned?
FATF requires us to do two broad things as a country. The first one is to pass the legislation that effectively widens the net of people who ought to be compliant beyond banks, to include the likes of gaming organizations, estate agents, and so forth. And the second thing that is required is for us as a country to tighten the risk management framework of the country, as it were, and make it more difficult for people to make inappropriate payments. And in addition to that, accelerate the prosecution of people involved in anti-money laundering, money laundering, terrorist financing, and proliferation financing. The first of those has to be done by October. That is dependent on the laws and regulations of the country that determine how legislation is passed. And this legislation is legislation that cuts across several departments. My understanding is that the authorities are working hammer and tong to make sure that they can pass the legislation. The second bit, I think, is a little bit more challenging in that it'll take some time for the system to be tightened and for prosecutions to happen. One hopes that there will be enough evidence on both fronts to persuade FATF not to greylist us. If we are greylisted, the first thing to bear in mind is that this is likely already included in the country risk premium, which people use to calculate the cost of capital for the country. But in addition to that, it is something we just do not need, because it's going to increase the friction costs, the cost of doing business in South Africa.